On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. One of the biggest talking points for investors this last year or two has been the increasingly concentrated nature of the US share market. And that's because the three biggest companies in the S&P 500 index, which are Nvidia, Apple and Microsoft, they've gotten so big in terms of their market capitalization, their market value, that they account for about a fifth of the index. When you look at the top 10, which includes those three obviously, and the likes of Amazon, Meta and Alphabet, the top 10 represent a whopping 38% of the index today. Now, over the past 50 years, the top 10 have usually been about 20 or 30% of the index, but 38%, that really is a much, much bigger share. And unsurprisingly, this has made a lot of investors nervous because you've got a few mega cap stocks that now have a much, much bigger influence over where the world's biggest share market, and therefore most of our retirement savings, are headed. However, this isn't completely new or unusual. The performance of share markets has always been dominated by a small group of big winners, and there's a really famous academic study that was released in 2018 by Professor Hendrik Bessenbinder. I hope I've got the pronunciation of his name right. If you're listening, Professor, hope I got that right. He's from Arizona State University, and this study is also one of the most relevant and hard-hitting for investors like you and me, just regular investors. He titled it, "Do Stocks Outperform Treasury Bills?" And what he wanted to do was examine the lifetime returns, and we're including dividends here when we talk about returns, reinvested dividends. He wanted to examine the lifetime returns of every stock traded in the US since 1926. So it was a big, big group of stocks, basically the last 100 years worth of US stocks. And he wanted to compare them to Treasury bills, which are a very low risk short-term deposit with the US government. So they're essentially representative of the risk-free rate. They've done about 3 to 4% annually over the past 100 years. In contrast, as we all know, US stocks have performed much better than that. And I talk about this a lot in these episodes and in my reports. The typical return or the average historic return is about 10% over the last 100 years for the US share market. So 10% versus 3 to 4%. But remember, that is an aggregate, and that is US stocks as a group. So Bessenbinder was more interested in how many stocks, what proportion of stocks had actually beaten that Treasury bill return on an individual basis. And his findings were staggeringly blunt, to be honest. The analysis showed that most stocks don't do very well at all. He looked at 25,000 odd companies in his database, and the median lifetime over his analysis for each stock was 7.5 years. Now, more than half of the stocks that he looked at delivered negative returns over that period. Some of them even went to zero, but only 4 out of 10 proved better than simply sitting on the sideline in Treasury bills. So with that in mind, you've got to ask yourself, how on earth has the market performed as well as it has over the long term? Well, here is the crux of it. This is what he found. The typical stock on an individual basis ends up being a disappointment, but there is a minority of superstar stocks that make the whole system look great. And that was his key point. That's what he concluded in this study. He found that the entire net gain from US shares over the 90 years in his study that he looked at, the entire net gain came from just 4% of companies. The other 96% collectively matched the return of cash, and investors didn't get compensated for that additional risk that they took by owning stocks over Treasury bills. What does this tell us? Well, the share market is far from a level playing field where most stocks truck along at a similar pace. In truth, it can be a giant winner-takes-all machine where you've got a small group of companies that end up dominating proceedings and delivering most of the gains. We've seen this across multiple eras, whether it's the railroads, whether it's the oil giants, the internet leaders of the 1990s, or the tech and AI behemoths of more recent years. So while the influence of superstar stocks on returns is not new, today's market concentration is unusually extreme, and we shouldn't ignore that. Current trends can't continue forever, and there is surely a limit to how large and how dominant those biggest companies on the market can become. At some point, investors will start to question the structure of the market, and you might even see regulators pay more attention too. Today's heavy hitters, they could eventually face competitive pressures or other challenges, just like their predecessors did. ExxonMobil was the biggest stock in 2010, General Electric a decade earlier, and IBM 10 years before that. A lot of younger people probably don't even know who those companies are or what they do. Now, these comparisons might seem foolish given how strong the heroes of today's market really are, but who knows where we'll be in 2035. I think the most important message for the everyday share investor is that diversification is essential, not optional. Share markets have performed fantastically well over the long term, but there does tend to be a small group of big winners that drive a lot of that growth. Now, picking which stocks those will be for next year or the next decade is incredibly difficult, but if you miss those, it will be costly. The market has always been inherently uneven. A few stocks will surge, many will struggle, and some will even disappear. That concentration is part of the investment landscape, and we need to understand it rather than fear it. That's all for today, team. Thanks for listening. We'll talk again soon. Enjoy your week.
For more insights, visit craigsip.com.